please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
All right, not looking good for the bulls at the moment. Not the frontline indices so much, but it's the mid-caps that are falling. The bank Nifty has actually dragged the market lower. Now names like Kotak Mahindra Bank, Axis Bank not looking good, down 1%. Anuj, a similar trend to what we saw on Friday.
Oh yes, as of now the range not been broken, Sonia, but one thing which stands out is Bank Nifty is a bit weak and there's a bit of a global risk off. By the way, I just want to point out, we've all been talking about HPCL, BPCL as a crude play. I think the biggest crude play right now that we have is ONGC. And if you see, that stock is actually making highs of the day. And the reason for that is very simple. 60 to 70, if crude settles in that range, that's Goldilocks for ONGC, because above 70, we have seen fresh noises of, all these subsidy burden coming back. And I think that explains that, you've seen that stock actually making highs of the day while the other stocks have pulled off a bit.
Okay, well, on that note, let's just bring in our next conversation in. We have Sanjay Agarwal, MD and CEO of AU Small Finance Bank joining in. AU Small Finance Bank needs to meet the 75% priority sector lending target by June this year. Obviously, they're looking at some big growth targets as well. Thanks very much, Mr. Agarwal, for joining in. Let me actually start out with a broad question. I mean, we are almost one quarter down in the new fiscal. In terms of growing the book, what is the outlook that you have? What kind of numbers and targets are you working with?
No, I think last year also AU has given around 50% growth in their AUM. So I think last year was exceptional for us, but anything around 40% on AUM growth we are targeting, and I think this first quarter is also good enough. So I think you will see our result, post 30th June. So overall, I think things looks better. Things looks more, in favor of the lender in terms of the market expectations, the deliveries, and overall economic scenario.
Okay, but the credit sentiment, has it picked up compared to when we chatted the last time? I mean, last time you had indicated to us that the credit sentiment in SME was still quite muted. Have things changed since then?
So I think last time also we commented that the demand is there, the competition has intense, right? Okay. So I think that is continuing. So right. Okay. So I think that is continuing. So ground demand is good, stable. It looks very rosy for us, but I think you have to manage our own product delivery services to manage and to beat competition.
Sanjay, cost of money has been moving higher and bond yields are fairly stubborn. I mean, now oil prices are down. Let's see if there's a big cool off, but otherwise fairly stubborn around 8%. What does that mean for, your asset liability situation? What should we expect on margins in the next 1-2 quarters?
So I think that's the main discussion point in our internal meetings also, because the interest rates are firming up, and we being a new bank, so we don't have that room also available with us, that we have a lot of resource to our disposal. So, around 50 basis point, the rates are firmed up. So I think it's not easy to transmit this money to the customer in this intense competition environment. So, but I think from last 2 weeks, things are softening side. And I believe that as we move forward on yearly basis, there might be a challenge around only 100 basis points. So, and that we need to figure out that how we manage internally.
Let me try and understand this. So from what I gather, it's quite clear you are a smaller bank. You do need to compete quite fiercely, and it's a competitive market out there. So the NIM that we saw, which was 5% plus, when you say there's a 100 basis points threat, I mean, are you saying that there could be a margin pressure to the extent of 100 basis points this year?
Yeah, so that's what I'm saying you, because the 100 basis point, we have seen the rates are firmed up in first quarter. So if that trend continues, for whole year, then that will impact. But how we are able to transmit to our the borrowers will be the real challenge or real situation. So, but I think, as I told you in last couple of weeks, we are seeing some softening side on the interest rates, and as we move forward, we believe that somehow, some part we can still transmit to borrowers, and somehow we have to manage our own internal balance sheet.
Okay, I wanted to understand the kind of traction that you're gaining as far as new products are concerned, whether it is gold loans or even, consumer durable loans. I know it's a very, very small portion right now, but what kind of growth are you seeing?
I think it's just a very initial start for AU Bank. We have just beginning to build housing, consumer, two-wheelers, gold loan, and initial traction is well good because this is it's a more of a pull platform. Customer comes and they expect that bank can deliver all those things. So it's very initial days, but we are very happy to see the traction and happy to see the growth we are getting initially from last 2 to 3 months.
When you talk about this growth and 40% AUM, what are the key parts of the market that you will target? Where will it come from, Sanjay?
I think we are targeting more on a commercial assets, which is around vehicle, business loans, business banking, NBFC. So I think this will have around 80% of our book, and we are in initial phase to build housing loans, consumer durable, and two-wheeler, gold loan, So I think that will supplement them in a smaller way, but in a large run of scheme of things. I think all this will put together will be in a better position in next 2 to 3 years.
All right, Sanjay, we'll leave it there. Thanks a lot for your time today. That's AU Small Finance Bank. By the way, don't lose sight of mid-caps and really the stocks where you have seen, clearly some problem over the last few days are making lows of the day. Just pull out some stocks intraday. For example, a CG Power is making lows of the day right now. That stock is quite interesting. Look at the chart of PC Jeweler. That stock right now is tumbling, and that sometimes is an indicator of what's happening in the broader market. Just pull out the chart of PC Jeweler, and Canfin Homes is the other one which is making lows of the day. Good time to get our technical analysts back, Mitesh Thakkar and Prakash Kaba, with us. Mitesh, interesting first hour so far. Couple of pharma names doing well, but otherwise weakish sort of broader market. Your thoughts and your stock calls?
Yeah, I think finally, we're catching up with the SGX part of it. But my sense is that I think this market might continue this market kind of movement might continue for next 1-2 days. If we break 10,775, we might have another cut of around 70-80 points. But I'm not looking at a big move happening on either sides. So it remains a stock specific market for me. I, in fact, have one buy and one sell call. Titan is a sell with a stop at 906. Look for targets of around 875 to begin with. I think 860 could also happen there. And Bata, I think, is showing good traction early in the morning. It's moved up slightly since I mailed it to you, but around 790, 792 would be a good buy. Keep a stop at 774. Look for a first target of around 825.
Okay, fine. That is on Bata. Prakash Gaba is also with us. Prakash, the market is falling some more now. Any shorting opportunities you see in the metal space? Because all of them top the list. Vedanta, Hindalco, Tata Steel, and anything else that you would be looking at?
Yes, certainly. To me, like the bias was down, so I feel that PC Jewelers is a stock that I would look at. That's killing it. I think it can see a slide around 144 to 138 zones. It's deep cut out there available. Stop above 159 has to be deep here. But yes, PC is sliding. Oh yes, among the metals, I do like Vedanta. That looks weak. Can see a slide around 220 zones. May take a day or two. Stop about 235.
Okay, just pull out. Yeah.
No, I was just saying the fall. Suddenly we were talking about that buying coming in mid caps as well, and suddenly we're down 0.5%. Nifty again 10,800.
The trap is on, Surabhi. This morning, because the market opened much above, what the SGX Nifty bargained for, I think a lot of people would have jumped in and created long positions. The markets, I think, are just taking that off. Midday, it won't surprise me if somewhere around Friday's low, 10,750 thereabout, if there's some buying which comes back. It's basically a range-bound market, and you have to play it like that. I think you have to realize that this is not 2017, this is 2018, completely different market, and this is a market where follow-through is missing. So if you're taking a call at 940 looking at top gainers and top losers, I think the market's in a bit of a surprise for you, and that's what's happening right now.
Okay, well, let's keep an eye out on this market. It is at the day's lows currently, and you know what? The market breadth has really worsened now. It's almost 1,300 stocks on the declining side, and this accelerated quite suddenly just in the last 10-15 odd minutes. But let's do one thing. Let's shift focus now to our Hunt for Value segment. Today, what we're doing is highlighting a pharma stock that bucked the trend in 2017, but seems to be losing a bit of favor right now, or has it? Ekta has more details on all of that. Ekta.
Thanks very much for that. Well, the stock that we are discussing today is Cadila Health. That stock saw a 40% rally in the span of few months in 2017, which really bucked the trend in the pharma sector, but fizzled out since and is now about 25% off its 52-week high. From that, re-rated after the re-rated after the warning letter was lifted from its Moriah facility in 2017, and despite strong launches in the US and a good regulatory track record, it failed to sustain that momentum. Now, the reason for the underperformance is likely to be due to a lack of significant triggers. This is because a few of their biggest launches, Lialda and Tamiflu generic, were done in FY18. Hence, for FY19, despite the company guiding for growth, it will come at a high base for FY19, making the street quite skeptical. More so, these same drugs, ulcerative colitis drug Lialda generic and flu drug Tamiflu, will see more competition this year, hence reducing their contribution. The other risks include delayed approvals in the US, slower launches despite approvals, price pressure in the US and India, and overhang of possible fundraising. However, the triggers, according to many analysts, could be the following. If the company manages to launch 50 drugs as estimated by the street in the US in FY19, including key drugs such as high blood pressure drug Toprol and digestive drug Prevacid. Also, the company expects its biosimilar and vaccine business to really scale up in the next 3 to 5 years. But steps taken towards building it would definitely be taken as a positive in FY19. Also, a continued track record of FD inspections. For example, the company cleared 7 out of 9 observations by the US FDA in FY18 without any observations. So whether that trend continues will also support valuations. In terms of brokerages, Deutsche Bank has a buy rating with a target price of 447. JP Morgan is neutral on the stock with a target of around 400 rupees. In terms of valuations as well, in terms of PE comparisons, it seems to be a little lower than its frontline peers on an FY19 and FY20 basis. Before I wrap up, a quick disclaimer: the stock is not a buy recommendation by us.
All right, thanks Ekta very much for that. Yes, that's an important disclaimer. This is just a lot of the data points and research that Ekta has put together on this stock. Let's actually go across and ask an expert whether this is indeed a bear trap or if this is a great entry point on Cadila. We have with us Surajit Pal joining in from Prabhudas Leeladhar. Surajit, your take on Cadila?
Cadila is a good stock, currently, given that all the clearance they have and consistently they're clearing all the observations they have, and the kind of the pipeline they have. Definitely they have a very good future in near to medium term. But the point is that both Cadila and Aurobindo are doing good performance at a time when the industry's perceived value of valuation has taken quite a dramatic shift. Earlier, what used to happen with the good drugs or the complex drugs, when get approval and good earnings, people used to consider as a part of the core earnings. But currently, any kind of all those earnings, people take it as a one-off, because when the kind of competition and the price erosion comes into picture, people don't think, or the analyst community don't think that is sustainable. So as a result of it, they remove that part and then they calculate the rest of the things with their core earnings. So the P from that perspective is not that cheap for anyone. So is Cadila. But if you compare with the large peers, definitely Cadila and Aurobindo are lower from that perspective.
So in terms of an upside from these levels, what do you see, Surajit? Because yes, the company is good, the stock is good, but pricing pressure is something that has bogged down a lot of these companies over the last few quarters. Given that it does have a few hurdles, do you think that there is a big upside from these levels?
I think Toprol could be a picture, but Toprol, mind it, it is not yet launched. It's a complex drug. Ramping up its production is also pretty tough. Currently what happened is that FDA is also asking whoever has filed Toprol is that about the scale up data, so that's why you are also getting less number of people to get approval or possibility of that. I think Cadila could be one of the big examples where they got approval, they could not launch because of the scale-up activities. So, other than this, I think last year they have one mesalamine molecule. This year they will have, and that molecule will be crowded by 4 or 5 guys July onwards. So, I think outperformance of their last year US sales may not be great. It could be single-digit growth.
Okay, all right. Thanks, Surajit, very much for that. That's the take on Cadila. It's all over the place, this market. Very, very narrow range, but the direction is changing so quickly. Couple of stocks just pointing out, the buying on ICICI Bank is definitely working for the bulls this morning. 2.5% up on that stock. Can't ignore that. There's ITC and Bharti Airtel. Again, some stocks which are in positive. ICICI is at the day's high. And the other stock to keep on our radar is Indiabulls Housing Finance. There's a tremendous bout of buying that's come in from the lows. We'll get in Nimesh in just a bit to explain what's happened, because promoters sold stake, but there is a twist to the tail, and we'll talk about that in just a moment.
So again, the market's going to, but one thing which stands out is ICICI Bank, I think, has got something good going for it, and that's going to support the market for today at least. I think the kind of buying that you're seeing on ICICI Bank, really 2.5% higher on that. And every time it's going to 280, it's bouncing back. Though I think the market will wait for this final outcome on Chanda Kochar before, making that big move. Or for it to be reasonably clear that, the succession plan is well and truly on. So far, so many times it's been reported, you would rather wait for the actual event. But definitely this big buying every time the stock's approaching 280 or thereabout.
Oh, absolutely. And there are steps being taken in that direction, right? First, there was an intern Supreme Court probe, and then there was a succession plan. Yes. Now, some names have come out in the market. Of course, all source-based, nothing confirmed from the management, but the stock is pricing in a lot more. But let's do one thing. Let's get back to the chat that Anuj had with influential investor Shankar Sharma. Here's a slice of that conversation, his thoughts on what the key risks are for the Indian market going ahead.
I'm telling you that I see so many companies, so many really cheap. People say it's expensive, and they pick 5 stocks and it's expensive. And I find so many good stocks with great visibility, trading 5, 6, 8, 10, 12 times earnings. Growth is strong, or it's visible, there's no leverage. And that's where I'm hunting. And there are plenty of fish in the pond, without any doubt. So I'm very, very optimistic on small caps.
Okay.
Irrespective of macro.
Exactly. That is what I was coming to, because once again, going back to 2017, there's a lot of talk that what you had was a cost of 2017. There's a lot of talk that what you had was a cost of capital rally, and now that of course is going up. Sure. We've had RBI also raise rates in the last policy. So is that going to be a bit of a risk then?
Yeah, it is a risk. I mean, let's be honest about it, clear about it. And I've called out on oil several times in the last couple of years from 2016 that when it was in the high 20s or the low 30s, that you're beginning a oil bull market. And I still believe we are in an oil bull market. That continues to be a genuine risk for India. We all know it, that, and I always said India trades between 2 liquids. One is oil, one is water. Water being the monsoons. So our economic fortunes are on one side it's oil, the other side it's the monsoons. We'll see how the monsoons go, but oil is problematic. But that said, which is why again come back to small caps, that they are not correlated with the macros. So if you're troubled with the macros, I am, and nobody sensible would not be, because you have a widening current account deficit, you have a widening fiscal deficit, or if you contain the fiscal deficit, then you have a problem on growth. And then of course you have a rate cycle which is now turned for the worse. Growth isn't great, it is tepid. So all things put together, the macro is problematic. But therefore, I still need to have a view or find investments, and that's why the small caps offer a very good place, because they have nothing to do with oil prices or RBI's policies or even the politics of the country. But the large caps will be not bad, but don't expect blowout things from this stock market 1 year out.
Okay, so Shankar, in the small and mid caps, what are the broad themes that you're working with? You made a killing in specialty chemicals, for example, about 2 or 3 years back because of the China factor. A couple of infrastructure stocks, you have made huge money. What are the broad themes that you are now backing right now?
Well, like I said, broadly and again out of luck, I think, more than competence. We just found that a lot of industries had a lot of surplus capacity, which they built during the boom years of 2004 onwards. And then because the capacities are fueled with debt. And then there was a downtrend in the overall commodity cycle, which started around 2010 until 2016. They all basically hurt, and many of them went out of business. So steel is a good case in point. Or on the other hand, you have infrastructure, where there were a lot of players bidding for a contract. Suddenly, that whole thing shrank to 5, 6, 7 players. Optical fiber cables is a good industry. That was an industry, the traditional overcapacity, oversupply industry for the last 25 years, because there were like 25, 30 players. Now, because of that problem, many players exited. They shut down. Now you're left with basically a handful of players, and just 5 or 6 players, while the scale of the opportunity is massive. So steel is again, similar. So in a lot of industries, we found that because of the excesses of the boom era, they were over-leveraged, they went bust or exited, and then market shrank in terms of number of players, but the opportunities still remain quite sizable. So steel, infra, chemicals, all these spaces have looked very good. Cables.
Yeah. This optical fiber is interesting. We, of course, have one large player who has done well in terms of stocks. On the others, are there concerns about balance sheet or management or any other concerns over there?
Well, I own one of them. There are no concerns as far as I'm, because the balance sheet is very, very good. Company has no leverage. They have repaid debt.
Yeah.
And like I said, every company goes through some problems. I mean, which company has had no problems?
Yeah.
Okay, across the world. It's how a management deals with those problems that, in my book, is what determines good or bad management, right? So, I mean, this company has done well. I mean, they've cleaned up their act. They've got their act together. The numbers speak for themselves. And I think the industry looks very, very good.